Thank you very much. It's a pleasure to be here. I am a technophobe, so if things go south, please accept my apologies ahead of time. About a week ago, I had to do the same thing at USDA's Outlook Forum in Washington, D.C., and unlike you all, we didn't have the technology of just clicking and the slides, hopefully, will magically appear. We had to, being economists and lazy people, we kind of waited to the last minute to give our presentations, and there was no one there to load them in. So there's a question of how many economists would it take to load a PowerPoint presentation. The answer is frankly more than 3. And at one point, somebody had to cover the open microphone, which we didn't realize was open at the time. So it's also very nice that your organization is terrific, because you put Barb between me and the first speaker, so that you don't remember, hopefully, what he said. So if I'm giving you something totally different on what we expect trade to be like, you won't notice that discontinuity. However, today I really think that there is a lot of similarity between what we have to say. It's kind of interesting to hear that you all are all grateful for rain. We are frankly very grateful for grain. We're looking at a very, very tight supply situation in the U.S. On Friday, USDA did release its 2011-2012 price forecasts for the marketing year, and you can see that we are looking at corn. And I apologize, I didn't convert this to metric tons, but we're basically talking about corn at $5.60 a bushel, which is going to be up from the average of about $5.40 in 2010, and well up from the $3.55 prices that we saw a little over a year ago. Soybean meal prices are going to be about the same as they were this year, somewhere in the range of about $360 a short ton, which again is up fairly substantially from where we were a year ago at $3.11. So what does that imply? It implies that there's going to be some shrinking returns for poultry and livestock producers. We did see a recovery in 2011 in terms of returns, primarily driven by the very high livestock prices. Unfortunately, those high grain prices are going to start to catch up with us, and these are very simple ratios of the farm price of cattle to the farm price of corn, the farm price of hogs to corn, and broilers to a mixed feed ration. But as you can see, there was a bump up in 2010, and we do expect to see that in 2011, implying that producer returns are going to be squeezed. So we're looking at potential in 2011 for offsetting meat production, probably higher beef and lamb and mutton and turkey, lower beef, lamb, mutton, and turkey production, and higher pork and broilers. In total, red meat production will probably be very, very close to where we were a year ago, about 0.1% higher. Now, what's interesting is we saw earlier how the Australian commodity mix is, and let me go ahead and give you an example about what the U.S. commodity mix is. If we look at beef, we're talking about roughly 29% of total production is coming from beef, about 24% of our pork herd, and about 40% of broiler production is represented in the total production of all meats. I know lamb is very, very important to you all, but unfortunately for us, it is less than 0.2% of total production. If we look at the production in total of meat in the United States in 2011, we are talking about a little bit over 41 million metric tons, which is down from our record in 2008 of 42.6 million tons. If we turn very quickly to the total meats, you can see where we're standing on our individual commodities. In 2010, beef production was actually up about 1.4%, pork was down about 2.4%, and broilers were up about 3.9%, for a total meat increase of about 1.3%. We do expect to see, as I said, some mixed results in 2011 with lower beef but higher pork and poultry. Turkey will be down about 0.3%, and lamb, which is only about 74,000 metric tons, will actually drop to about 71,000 metric tons in 2011, down about 4.3%. We got the most recent lamb inventory report from USDA, which reflects our January 1st numbers, and at that time we were talking about an inventory of sheep and lamb in the United States of about 5.5 million head, which was down about 2% from the previous year. We're also looking at a decline in our breeding lamb inventory of about 2% as well. So the general contraction in the U.S. lamb industry in 2011. Against that very minimal change on the total meat side, we are expecting to see stronger red meat exports, but weaker broiler exports. Our forecasts are being driven, as mentioned earlier, by rising incomes, which is going to fuel increased demand for meat protein in general, a relatively weak U.S. dollar, which will support our meat exports, both in terms of reducing the impacts of the higher prices for the U.S. product for foreign consumers, but also providing us with a competitive advantage against a number of other countries. Unfortunately, from our standpoint, trade issues still remain. We have several trade issues which remain irritants. One of them is obviously the continued restrictions on U.S. Beef due to BSE. We also are seeing some anti-dumping and countervailing duty actions by China against U.S. poultry, which has basically made poultry exports prohibitive to those countries. And there's recently been an announcement by Mexico that they're also going to be undertaking an anti-dumping investigation against U.S. broiler meat. Nothing particularly there. Russia has decreased its quota in 2011 for broiler meat from 750,000 tons to 350,000 tons, which is a major factor for the U.S. Prior to last year, the U.S. actually received a country quota allocation for poultry meat exports to Russia that provided us with the lion's share of that 780,000 tons. This year, the Russians have announced that there's going to be no country quota allocations. So we're going to be competing against countries like Brazil. We're going to be competing against other countries for access to the Russian market. If we look at where our exports are going, we are looking at higher red meat exports. In 2010, beef was actually up about 18%. Pork was up about 3.2%, and broilers were fractionally lower, reflecting the fact that we couldn't ship to China, that we had a trade dispute with Russia over chlorine wash, which has since been resolved, but limited our access to that country for a very large portion of the year. What actually is surprising is, given our reliance on Russia in past years, I think the broiler industry did a tremendous job finding external markets for U.S. broiler meat products. As we move into 2011, we're looking for about a 2% increase in U.S. beef exports, about a 10.6% increase on the pork side, but the declines in broiler meat exports of almost 2%, to a large extent reflecting the fact that we will not have access to Russia, that we assume as part of our policy that until the Chinese announce a change in their policy, we're assuming we're going to be very limited in their market as well. What has happened over time, though, is that red meats exports have become increasingly important to the U.S. As a share of total production. Beef is now expected to be about 9% of total U.S. production, which is fractionally below where we were in 2003, prior to the discovery of BSE in the U.S. herd. Pork has increased tremendously, increasing to about 21% of U.S. production is now being exported overseas, which is interesting to note that when I started at USDA back in the mid-90s, we were talking about exports of pork representing less than 8% of U.S. production. So tremendous strides having been made in the export of pork. Poultry is actually going to be coming down a little bit. We estimate that in 2011, it will be about 18% of U.S. production, which is actually down from the 19% peak in 2009. So we've got offsetting meat production, which leaves us pretty much unchanged. We've got stronger red meat exports. So where does that leave us for the domestic supply for the U.S. consumer? Basically, we are looking at larger broiler meat net supplies and smaller beef, pork, and turkey meat net supplies. In terms of our per capita consumption, this is all done on a retail basis, where we take away a fair amount of the fat and some of the bones to reflect what consumers are actually buying at the grocery store. We are looking at total per capita consumption dropping about 0.7 of a kilo down to about 94 kilos. And again, as I said, we're going to see higher broiler meat availability, primarily due to the fact that we have both higher production and lower exports. But on the red meat side, we're looking at lower per capita availability, driven in the case of pork by the fact that the higher level of exports is going to be offsetting the increase in production. But on the beef side, we're looking at both lower production and lower exports. see if I can work this now. All right. And a lot of what is going to be driving the demand for U.S. meat is going to be gradual economic improvement in the United States. When our forecasts were generated, we were looking at GDP growth of about 3% per year. Since we put these forecasts out in mid-February, we have seen some increased forecasts in terms pushing us closer to 3.5. Yesterday, somebody had presented a number that was high as almost 4% for U.S. GDP growth. Again, higher incomes in the U.S. Will stimulate demand. Unemployment is a bit of a problem for us. We are a little bit south of 10%, somewhere around 9.7, I believe, last time I saw. We do expect to see unemployment gradually decline over time, but it's going to remain persistently high from a historical standpoint in the United States. So what does that mean? You have a confluence of roughly unchanged production, stronger exports for most commodities, and increasing demand. Very, very strong prices in terms of what's available on the cattle and the hog side. For an example, if we look at our 2010 numbers, those prices, and the top price is obviously on $1 per hundredweight. I've tried to convert it to metrics for you all. The percent change is really based off of the midpoint of the hundredweight and pound estimate, and those would be consistent with the midpoint of the ranges published in our World Agricultural Supply and Demand Estimates forecast. But we are looking in 2010 of beef prices that were about 15% higher, pork prices that were about 33% higher, broiler prices that were about 7% higher. In the case of lamb, which I didn't put in, we are talking about a lamb price that averaged for San Angelo at about 53, this is a live price of about $53 per 100 kilograms, which is about 30% higher than it was a year ago. In terms of 2011, you can see not quite as strong increases, but in many cases we're pushing records. Beef averaging $46 to $49 per 100 kilos, hogs between 26 and 28 for an average price. Broilers, again, because we have the larger supplies, lower exports, there'll be some downward pressure expected on broiler prices, somewhere in the range of 36 to $39 cents per kilo. Lamb, we do expect to see continued strong lamb prices. U.S. supplies are diminished. There's going to be limited supplies available from Australia, and we do expect to see probably increases of almost a third in terms of our lamb prices, which would be very good for U.S. lamb producers. What does that imply at retail? This is where the battle really takes place for the consumer's dollar. In 2010, beef prices at retail averaged about $1.99 a kilo, and these are very rough just because of the conversions. Pork at about $1.41 a kilo, and broilers at about 79.5 cents a kilo. We do expect in the case of in 2011 to see increases, in fact, in all the species meats, as we pass along some of the higher costs to consumers. Beef probably averaging somewhere between $2.03 to $2.05 a kilo. Pork averaging in the high $1.40 to low $1.50 range, and broilers in the mid 80 cent range. So again, consumers generally looking at increases, and despite its increase, though, chicken will continue to maintain its pricing advantage at retail. So we expect to see fairly strong demand on the poultry side. There is, however, this always becomes a problem when you look at retail, especially in a system of economic constraint, because there's a question of how far can you push retail prices up for consumers before they simply switch to other meats or before they move to lower value cuts. And I think we've seen that with very, very strong hamburger demand in the United States, which is very much to the benefits of the producers of manufacturing grade beef. Basically what we've seen is very, very strong demand for broiler breast meat, very strong demand for grinding meat. And the question is, how far can retailers push prices up before they meet consumer resistance? And if they have consumer resistance, where do they have to push prices back down on the chain, to the from the retail to the wholesale, from the wholesale to the farm? These high prices may simply provide a constraint on increasing farm level prices.